It is now come that time where we will do a Fed preview. We're going to bring in chart trader and event trader. So Gavin and Brett will join me today. And truth be told, I don't think there's two better guys that can break this down in terms of how to look at this and how to trade it than you two. So I'm excited to have you guys on to do this breakdown. So welcome in, gentlemen.
Thanks.
Hey, thanks, Jim. Thanks for. I'd rather be Powell than me though for trading it.
Yeah, but Powell can't trade it, so I mean maybe
I wouldn't rather be Powell.
Well, anyway, so what I want to do here is, gentlemen, start with our base case scenario. And then once we break down the base case scenario, what you expect the market to do if that comes to play. And then we'll get into some different scenarios and how the market may look upon that. So, Gavin, why don't I give you the floor, because you've already done a preview for this, and I'm going to refer everyone back to your post yesterday at 1630. Just type in EVENT and scroll down to the 1630 post from yesterday, and you'll get basically a recap of what we're going to talk about, or a little preview here. So, Gavin, why don't you talk about the base case scenario, and we'll work our way from there.
Yeah, I mean, I think the base case scenario that most people are expecting is for Fed Chair Powell to, and the Fed as a whole, not to make any moves on this, but to lay out the groundwork with some downside risk commentary, and I'll lay out some of the different ways that they could take a look at that. But I think the Fed doesn't need to move. We've seen that from the Fed funds futures, but they do need to provide the idea that they could move in the next one or two meetings, preferably in the July meeting, looking at the Fed funds futures rates here. So there's a number of different nuances that it could do this. And if you want to, I could break into that a little bit later. Or do you want me to go over that now?
You could do it right now if you don't mind. I mean,
sure. Yeah. Okay. So, taking a look. Basically, if you look at my preview, I laid out first the last time they were cutting rates, and it's worthwhile that their economic commentary was relatively. I wouldn't say upbeat, but they said that financial market conditions had deteriorated and tighter credit conditions and increased uncertainties had the potential to restrain economic growth going forward in these circumstances, although the recent data suggests that the economy had continued to expand at a moderate pace. This was back in August of 2008, right before Lehman, of course, and it laid out that the Fed could cut because of different conditions, despite the economy performing well. Now, obviously,
August 2007.
Or 2007, I should say. I'm sorry.
Yeah,
yes.
Right.
So anyway, as we can see, a strong economy isn't something that would keep the Fed from moving, or at least providing a risk of downside concerns. And basically, you can take out the credit concerns and the financial market conditions and replace that with trading. So, that's something that we'd probably like to see in this statement coming up. Now, we take a look at the May 1 commentary, and we could see that the last economic cover that they had was that, where is it here? That the economy was expanding at a moderate pace. Now, the language that we saw in the beige books showed a modest pace, which is actually slightly weaker in Fed parlance. So, we could see that replaced with more of a modest or a stalling type commentary. In the May 1 comment, we had jobs gains had been solid on average in recent months, and the unemployment rate had remained low. Obviously, the unemployment rate remains low, but we have seen a little bit of a slowdown in jobs, so the Fed could tweak this to state that. The household spending and business fixed investments slowed in the first quarter. I would expect to see comments around business fixed investment a little bit more cautious, considering some of the forward-looking statements we've seen from both the PMIs, New York Empire, and companies in general on their corporate calls and some of the earnings that we've seen as of late. The next thing up, we got the inflation area, of course, but I would expect them to maybe note that the longer-term expectations had slipped a little bit more here, or that they run a risk of missing that. So I'd expect them to be a little bit more cautious on inflation. The committee continues to view sustained expansion of economic activity, strong labor market conditions, and inflation near the committee's symmetric 2% objective as the most likely outcome. Here is another area where they could tweak, is they could say that there's more downside risk to the committee's outlook. And then the final May 1 statement piece that I have is, I think, arguably the most important. And that's the statement that include patience, as I think most people want to see the removal of patience from it. I think you're going to have a lot of bots trading this, specifically looking as soon as that statement hits for the comment of patience. And if it's out, you're going to see a pop in it. And that's just my gut feeling on how we've seen the bots trade this in the past. And I think that that's probably going to be the most important thing for the Fed to hit. But as we can see, they've got a number of levers in the statement alone that they could attack in order to provide a little bit more of a dovish note. The other item that I would throw in there that I don't have in is, if we see a dissent from Bullard, that could raise a little bit of a red flag that the statement is not going to be dovish enough for some, because I would assume Bullard would be dissenting perhaps for a rate cut there and laying the groundwork for it. But I think more than anything is, if we see a dissent from him, I think it would be on the idea that the Fed language wasn't strong enough. So that's going to be another thing to keep an eye out on. And then, of course, we got the dot plots, which I've laid out, looking for a little bit lower right now. As of the last meeting, there was no rate hikes with 11 members. They had voted at 2.37%, 4 for 1 rate hike, and 2 at 2 rate hikes. This, as a whole, suggested that the Fed would hike one more time in 2019. So want to see this unwound, and then 2020, we also want to see that come a little bit lower. And I don't think that we can really look out too much further in 2021, as we've seen the Fed projections aren't really going to be that seriously taken, given how off they've been. And then, of course, there's the economic projections there with the GDP and inflation and unemployment and the Fed funds rate. That could be tweaked. And then the last thing that we haven't seen too many people discuss is the balance sheet normalization, which the Fed is set to unwind slowly. They started going from 30 billion to 15 billion in the unwind in May of 2019. So that was obviously just 1 month ago. Perhaps they suggest that they're going to delay this unwind, which again would be another positive for the markets. But there's a lot of levers that the Fed could pull. I think collectively the market would like to see all these levers tweaked a little bit, but I think more than anything, the removal of patience from the comment would be key.
All right, so would you consider that the base case, or I know you said that was your gut feeling, but is that kind of what the market is expecting just from your overall consensus?
I think the removal of patience and then small tweaks to each of the items that I mentioned is kind of what the market is looking for. I don't think that the Fed has to collectively do that across the board, but I do think that they have to hit on a number of these statements, and certainly the dot plot is another key one that the Fed has to do in order to appease the market that a July or September rate cut is on tap.
All right, Brett, do you concur with this sentiment as far as like the base case scenario is, or is there something else that you're looking for?
I think unquestionably Gavin has perfectly captured the base case scenario as I think probably the market sees it right now. So I think that if everything were to flow just as he outlined, it would be considered the least surprising possible outcome. However, I have started to talk myself into a little bit more of being on guard for a surprise cut today, and here's why. So I talk a lot about how the Fed has a relationship with the Fed funds futures and with communication, and that's mostly a principle that applies really well when we are in a tightening cycle. But peculiarly, the first rate cut of an easing cycle tends to be a surprise in terms of the Fed funds futures data, and that's because you rarely get a situation where just out of the blue, over a short period of a week or two, suddenly data comes in that's super growthy and inflationary, and so the Fed has to do a surprise hike. That's rarely the case. The Fed can really telegraph hikes. But you do get the opposite of that. You do get a situation where suddenly the deterioration in economic data happens more rapidly and more unexpectedly, and the Fed has what's called a blackout period. In this case, it started on June 8th, so they could no longer indicate anything about what they were going to do with policy after June 8th. And really, a lot of the data we've seen since then, I mean, if you take out the retail sales, because that was referring to May, but the data that's really kind of leading indicator data on June so far has been pretty awful. In terms of the Empire State number, biggest drop in history. The Morgan Stanley Business Activity Index, biggest drop in history. We saw the Michigan sentiment data come out with the all-time low in long-term inflation expectations. And then, of course, there's a lot of pressure, and then Draghi just came out a couple days ago and really kind of changed the course for where people were perceiving the ECB. So it's not impossible that they've been getting ready to cut for the last 12 days, and since they're in a blackout period, there was no way for them to indicate that to us. So the Fed funds futures would be relatively unreactive to that process. And then there's one other reason, and that is it's a tough situation with the pressure that the White House is putting on the Fed right now for them to cut at all, because it risks their credibility. It makes them look like they're kind of just going along with the White House is telling them to do, even if they have their own reasons for it. It's bad optics. But I would say they could be cornering themselves into an even worse optics situation if they just really indicate that a cut is definitely coming in July and they don't do the cut now, because that opens up the possibility of the market racing to new all-time highs, and suddenly you have even more pressure probably coming from the White House at that point because they didn't cut today, and you have an S&P trading at all-time highs and unemployment at all-time lows. And that just really, for the general public, that just looks like it's just too easy to say, oh, the White House now controls the Fed. So I think that they could actually be, even though it would look like, they've got the same credibility problem cutting today, I think it would be even worse in July. So it's not impossible we could get a surprise cut today. Otherwise, probably not.
Do you think it would look worse politically if they cut in July as opposed to today?
Yeah, because probably the White House is going to be even more pressure in July, and also we could have the market at all-time highs, which looks like, to the general public, and I'm not talking about to economists or Wall Street fund managers, but to the general public, and splashed across the top of the front page, it just looks like, how could the Fed be cutting rates with unemployment at all-time lows and the stock market at all-time highs? Oh, here's why, because Donald Trump told them to over the last 5 days a lot. I think that looks worse than doing it now, where we just got Draghi sending the signal he got. We just got a few pretty bad data points, and the market is well off its all-time highs. So I think that this would look maybe not quite as bad, because also, the White House is...
You don't think there would be a tweet at 2:07 p.m. about how Powell's doing a great job and he's a hell of a guy?
Yeah, right, but that would also happen in July, and it would be after 5 days of, a tweet campaign threatening his job. And they've been a little bit less like that over the last few days. They've been, doing some oblique things, like leaking to the press that they were exploring how to demote him yesterday, and about, going after Draghi. Like, it's not been quite as direct as Powell, we're going to fire you unless you cut tomorrow. But you might get something like that in July. So, it's they've got a little window, maybe, I don't know how they're seeing it. Obviously, what I'm doing right now is theory of mind on Powell, which is awfully tough. But, I'm just theorizing. And also, I think that, again, I think that there is a historical case to be made that the first rate cut in an easing cycle is usually a surprise. It is usually a surprise because, again, you get the blackout period and the Fed funds futures can't react, and oftentimes the first cut happens because of an immediate and sharp and sudden deterioration in data, and that's something that happens over a week or two, and usually during that blackout period, and then you get the cut. So oftentimes that's the kind of situation that characterizes the first cut. And again, hiking is different. Hiking is a more gradual, more easily telegraphed process. If you just look at the short-term interest rate chart going back long enough, you'll see the upside moves are very gradual. It's like it's on a conveyor belt, and the downside moves are very erratic and sudden and sharp. So, it's more reactive. It's more breaking economic news that suddenly shows something that they didn't anticipate. So, I think that we shouldn't just necessarily discount the possibility that you'd see what I would call a surprise cut, simply because you don't have
anything under 60%
markets prepared for
would be
it.
a surprise, right? You figure.
Yeah, well, right, historically, but again, that rule of for me, it's the 70% rule from Larry Summers, but that rule really kind of applies to a hiking cycle much more so than to the easing cycle, particularly at the beginning of the easing cycle. And once you're in a situation where you're in an easing cycle and people can see the data, it gets maybe a little bit more telegraphable ahead of the blackout. So I feel like everybody is so used to being able to handicap what the Fed is going to do well in advance, because it's been, a long, long time since we've had an erratic change in policy. So I think that we should just at least be on guard. Probably it's going to flow just like Gavin described. But I'm just making a case that it's not impossible that we could get a surprise.
Well, you took one of the words out of my mouth, Brett, because I was going to ask you to handicap what you think the probability would be of the surprise rate cut. And if it does happen, what does the market do?
So that's the bigger question, and there is the historically the first cut leads to new all-time highs, and then you start to roll over later as people realize it can't be solved by a rate cut.
Later today or later in the?
No, later. Well, new all-time high. Like we got the first cut in 2007 in September. We made new all-time highs in the market a month later. And it really lit a fuse under the market, because people are still thinking, well, for the most part, things are good, and now the Fed is behind the market. And it just really it takes a while for the type of stuff that the bond market appears to be looking at to really get into the public eye about the stock market. And with the malpositioning situation that Gavin and I talked about on Monday, has been further reinforced by the fund manager survey from Bank of America. Yeah, you've got folks who are, their careers are riding on making sure that they're not left out if we get into a new leg of a bubble. Like we saw in 99. I mean, that was after the Fed started cutting rates. And we went off into a bubble, and folks got really bearish following LTCM, and then they just had to fly back in because valuations were awful in that period. It was really easy to make a case it was terrible to be in stocks, but you'd lose your job if you're managing other people's money on Wall Street and you weren't long the stock market during that period. And you could have the same kind of situation here. If we cut rates, market starts to break out to new all-time highs. Trump starts to tweet about a trade deal coming together with China. That money's going to have to come off the sidelines and into the market. So I think that it's possible that it would be a bullish thing with some follow-through. But there is the possibility that it would also say, since people aren't expecting it, it would say, it's, and I guess a lot would have to do with how Powell handled the press conference, because that would open the door for the idea that the Fed knows something we don't, and that they're talking behind the scenes with big banks and big businesses, and things are just falling through the floor. The people their imagination start to think, oh, it's a surprise cut. There must be a crisis going on that we don't know about. So it's possible the reaction would actually be a knee-jerk to the upside than a sell-off until Powell kind of explains it in terms that people are able to comprehend, with the ability to, see that as part of somehow a bullish context.
Yeah, I'd agree with that wholeheartedly. I think that you'd definitely get the pop and a pretty violent reversal going into Powell's thing, and then it would all be on his shoulders to see how well he could explain why they did that move.
I'm not suggesting this should be our base case view going into it. I'm just I'm pointing out that the idea that expectations match what the Fed does, which we've been pretty used to. The Fed hasn't surprised us really in any way. I mean, with the possibility of being a little more dovish than we thought back in February, I guess it was. But knowing that they'd flip to being dovish, but then way more dovish, and really moving up the date of, ending quantitative tightening and stuff like that. So they did a little bit of that then, but we haven't seen much surprising stuff from the Fed for a decade. The surprises tend to be during periods when things are starting to become genuinely rocky on a cyclical basis. So I think people are maybe a little bit too complacently in the idea that there's no chance of the cut happening today. And given the quiet period and given some of the data we've seen over the last 12 days, I think it's maybe a bigger chance than is showing up in the Fed funds futures anyways.
So was that February where they flipped to being dovish?
No, they flipped to being dovish on January 4th at a panel discussion where Powell just said, we got the markets back basically, and that was really.
I mean, technically, I guess you could point to Williams 2 days after Powell
right
upset the market with the Fed meeting. That's when the PR campaign started. But yeah, January 4th with the panel with Yellen, Bernanke, and Powell's when Powell started putting his stake in the ground there.
Right, but you remember we had that cake and have your cake and eat it too kind of press conference that was maybe a month later.
No, the have your cake and eat it was the December one. Where
No, the other way.
For the other way, yeah, that would have been end of January, like January 30th.
They were saying growth is great, and we're not hiking anymore.
Yeah.
So they were really just basically, and we're ending quantitative tightening ahead of schedule, and growth is great. It was kind of really just everything possible
that could bounce.
Yeah, right. I mean, that was really surprising how all cylinders things were suddenly, and that was the only real kind of moment where I've been surprised by what the Fed did for as long as I can remember, because it's been so telegraphed, because they've gotten so behind the idea that they need to really message in front to really make sure that market expectations match what's going to happen. But again, in a situation where you start to shift toward an easing cycle, you got that blackout period, and when things deteriorate, it happens quickly. It happens suddenly, and perspective changes more quickly than they can maybe message. So, we've seen a lot of leading indicators about June, that June looks really rough. But the reason why I probably would still tip toward the scenario Gavin outlined is because a lot of that probably is something that behind closed doors they realize has to do with business investment expectations around what's going on with trade. And there is the G20 coming up. It's still a variable, and they could look like, idiots if they cut right now and then we get a trade deal somehow, at G20. So, I mean, obviously it seems like such a long shot, but there is that scenario that they could really look crazy for having cut now rather than waiting to see how things go.
All right, so we talked about that kind of sexy potential for that rate cut, but the more probable scenario is that things play out the way Gavin just described, and with that said, we should probably be aware of what you think the market would do if that scenario unfolds. So, without any further ado, what do you think?
You asking me?
Yes, Brett.
If the cut.
No. Gavin's base case scenario.
Oh, yeah, right. So, I guess nothing. I mean,
the market does nothing.
I think it's been so thoroughly covered. That expectation has been so thoroughly covered. I think that there's. I think that's why the surprise cut is interesting, because it feels like there's such a consensus expectation for the Fed to come out, say that, take the word patience out, and paint a picture that July, we're going to certainly not say anything to take July off the table, discuss some of the challenges, discuss some of the risks, and, leave in place the current rate and really set up the same thing that everybody's been expecting. And I really can't imagine, I suppose there could be a little money in the market expecting a surprise rate cut just for the same reasons I've outlined, and maybe that would come out. And as always, I try not to get too involved in attempting to pretend I know what's going to happen. I want to understand what can happen, and then I want to have a pretty open mind when I see what the market actually does, really over the first 2 hours or so. And really, to me, and I know this takes some of the wind out of how exciting today is for traders, but it really, really is a 24-hour period of digestion of whatever happens before you get that process that identifies things.
Yeah, and even at that, there's really two trading periods around the Fed. You got the 30 minutes where the market's left to its own devices to digest what the Fed's saying, and then the hour that Powell will be speaking. And, both could really present different outlooks. I think even more so than Brett's thought on a surprise rate cut, I think a bigger possible error would be if the Fed didn't lean dovish enough and, left the patient in there and wasn't viewed, and you see the dissent from Bullard, and just the idea that this goes back to December where the Fed's not moving strong enough, and perhaps it's not looking to not looking to get too aggressive ahead of the G20, or not looking to or looking to make it look like that it's not bending to the president's will or something, in which case, that's going to lead to a pretty direct sell-off in that 50-day moving average right around that 2880 area for the S&P. Just looking at the September futures comes right into play. So I think that there's a bit bigger risk of that than a rate cut myself, but Brett,
it's possible.
Brett does throw out an interesting theory with that, because that would certainly be the most aggressive thing that we could see the Fed do. But does that raise more alarm, or does it open up the door for all's well and let's jump into this?
I've got an interesting compromise of those ideas that was suggested to me by a friend. They could surprise cut and leave patient in, basically saying, we think the rate is too high right now, but we're not signaling an emergency.
Yeah, that'd be interesting. And you'd see some whippy action, I think.
Yeah. Again, that's the digestion, and it just takes, by tomorrow morning, you'd have a sense of what it means to the market.
Yeah, and I think that's one key thing. There are a lot of nuances to the statement and to actions that the Fed could take that needs to be fully digested here, but it's still going to lead to some whippy action in the meantime.
All right, so with that said, we know that the equity markets are going to be in play. I'm guessing that gold will also be on your agenda to at least watch and see what the reaction is. Brett, are you sitting tight with your gold position, or are you thinking about maybe reducing it at all? What's your thoughts on gold?
No chance of reducing it, no.
Okay.
The question would be, would I add to it, but, I think that I'm just content to let it happen. And I think that if we get fully into a breakout gear, I've got my ideas as to where I think that would need to go at a minimum. So the add possibility would be a quick, sharp, and powerful breakout above 1360, 1375, 1380, and then maybe just a sharp profit-taking pullback to maybe add into, because I think there's truly no chance if we get above 1375 that we're not going to see, 1410, 1420. In relatively short order. So I think that I would add to it using the futures. Yeah?
Hey, Brett, I was just going to say, because just like thinking of gold and the three end games that we kind of laid out there, I don't really see a bad case for your gold.
No, I mean, again, it's the big insurance policy.
Yeah,
it's this big long-term insurance policy. So, yeah.
The Fed's either going crazy with pumping liquidity in, or they're pumping liquidity in because the market's so bad that people are afraid and they'll run into gold. Either way, it seems like.
Yeah, no, I mean, it's kind of cornered things a little bit here for at least the primary ascending triangle breakout. Now, I mean, the bearish case that I can make on gold from a technical standpoint would be a move to 1410 and then a move back under 1350. And at that point, you'd have to call it a failed ascending triangle breakout. And then if you solve your trade war, if we start to extend the cycle, the Fed starts hiking again, you've got stable economic growth again, that's all the way that gold is back at 1200 by this time, next year or even before. But either way, I think that at this point, I just can't see how there's not that first move to explore at least some orders above 1400 and see. I think there's just going to be a kind of self-fulfilling prophecy, a kind of inertia to it when it moves above probably 1360 to 1365 at this point. And yeah, I don't see a scenario that the Fed could really, I don't see any way that is derailed by an outcome today, even if it maybe sparks a little pullback if they are surprisingly hawkish, but I don't think that it really changes the situation.
And Brett, you had some comments earlier today about what might happen in financials if we did get a surprise cut today. So why don't you enlighten us on what your thoughts are there?
Well, I mean, just so simply put, the rate cut would do two things, in theory anyways. And one, in fact, it would reduce the price of money at the short end for big lenders. And in theory, it would be an inflationary force, which would steepen the yield curve at the long end. And basically, that is a proxy for understanding net interest margin among banks. And if it was a surprise rate cut, then it would be a surprise move to directly expand the profit margin for big banks. So they tend to be the biggest beneficiary right off the bat when the Fed is surprisingly dovish. And I did just notice that, early on today, you had the market red and the KBE up pretty significantly. So, I mean, if you think about the infinite wisdom of the market, that's just somewhat interesting. I mean, there may be other catalysts, or it may have been technical, but it's interesting. And maybe there's just some short interest that's pulling out of those positions until they make sure that the Fed doesn't do a surprise cut. But that's just it's still part of what the market is doing.
Is that one of the tellers you've been using for the potential surprise cut, Brett?
No, I started thinking about it this morning, really. I hadn't really thought about it. I just kind of been assuming that they're, just following the normal process. And then I just kind of started to think about it and talked myself into it a little bit this morning. And then after talking myself into it a little bit, just noticing that the banks were strong was kind of a slight reinforcement. But again, I'm not saying that this is the most likely outcome, but I think that it's probably underpriced in terms of probabilities, based on the blackout period and some of the data we've seen.
All right, and I know we're going to talk about bond markets and how they respond, but in terms of a trading vehicle, are you going to be looking to trade any bonds or currencies or anything else?
I mean, the euro is an interesting possibility. Obviously, that's the direct hit on an unexpectedly hawkish Fed. And that will also be interesting to see how the euro reacts, given what Draghi just did. If we see that and the euro tries to bang to the downside and can't, then it's a really interesting signal about the market. Otherwise, I think that there's reasonable range expansion in equities. I'm probably still first looking at equities. And oil really just has an entirely different narrative going on that I think makes it relatively independent of what's going on today with the Fed. And that I'm still just kind of leaning bearish on oil and watching for it to start to look like this recent pop is going to fail and lead to maybe a test of the 49.50 area. But as far as reacting to the Fed, probably the most interesting thing that I would watch would be the euro in initial reaction. And then I suppose gold as well. It's not impossible that gold could see some fireworks under right conditions today and immediately give me that chance on an intraday setup for increasing my size for the move to 1400.
All right, Gavin, and are there any other markets that you're going to be really focused on?
Yeah, I think one of the more interesting ones will be following the JNK. Just to see, I'm curious to see how they react, because I think if we get too hawkish of a Fed here, that you could see this JNK really start dipping down towards that 200-day moving average. I think there would be some concern around corporate debt moving forward here. If you look at the latest Fed fund manager survey from Bank of America, I think that was hitting an all-time high in terms of concerns now. So I think J&K would be certainly an area that you'd want to be on the lookout for if the Fed didn't hit. If the Fed was viewed as not being dovish enough. So that's one vehicle that I'm certainly looking at directly here. And then I'll be just trading around probably in the S&P or the NASDAQ futures, looking for opportunities there. But, really need to see how things shake out and whether or not I think that the market has this right. My favorite scenario would be if we did see a pretty dovish Fed and the markets still sell off in disappointment for some reason that there was no rate cut, and that it came down for a quick test of that 50-day moving average, in which case I'd be looking to play a bounce off of that. But, a lot of unknowns right now, so kind of have to see how things shake out. But I'd be looking for either a fade or a bounce, depending on what kind of action we get. But until I get a better idea of what is causing the move, it's a little tough to prejudge that. But I definitely have the J&K on my radar as a market outside to keep an eye out on.
All right. Well, the good news is that you both will be on here to dissect what the Fed has to say in terms of not only their policy statement, but some of that Q&A as well. And we'll be able to get some color on what ideas you guys are tossing out there. And I'm telling you, that's one of my favorite parts about this whole channel here. So I'm looking forward to that. Gentlemen, unless you have anything else, I think we can wrap this one up for now. Any parting shots?
Not for me.
Yeah, none on my side. Obviously, Brett and I will be talking a lot as the news crosses and getting color out as soon as possible on it.
All right. Well, I'm going to be looking forward to that, and I believe all the listeners will too. So, gentlemen, as always, thank you so much for giving us this little preview of the FOMC that will be out in, what, just under an hour and a half from now, right?
Yeah,
All right. Well, thank you guys so much. I appreciate it so much, and I'm sure everyone else does as well.
no
All
problem
right,
at all,
thanks, Jim.
Jim.
All right.
All right.